Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, March 10th, 2017. So we have quite a bit on the plate today, so we'll pretty much do the same thing as always. We're going to go over stocks. I'll add some real estate and telecom into the mix. We'll take a very close look at bonds, especially the long-dated treasuries, which are very interesting. Dollar is pausing within a bigger uptrend, and gold had a pretty nasty week again and correcting. But if dollar trades sideways, maybe it will take advantage of it. Gold miners are deeply oversold, and we'll also look at the market breadth for gold miners. Big news, of course, for the week was oil, as it broke 12 weeks consolidation to the downside with over 9% decline. And we'll look at some of the oil stocks as well. And finally, we'll look at natural gas, which is gaining for the second week in a row. All right, let's start with S&P 500 ETF SPY. So last week we hit all-time highs. We had this gap up here, and I thought this was an exhaustion gap, kind of like the end of the move. Looks like we are pulling back after filling that gap. I don't think we have bottomed yet. I think we may need to trade more sideways and maybe even down a little bit. Anything is possible, of course. This is a bullish chart, but it is quite overbought, so it is really in need of a correction. As far as advanced decline lines, as far as market breadth, I think it's confirming all-time highs in the actual underlying index itself. Same goes here for S&P 500, actual underlying index. You can see we were overbought here on RSI, so we're basically just unwinding some of these overbought conditions. As far as longer term picture, I don't see anything right now to worry about. This is very bullish readings in the bullish percent index and percentage of stocks above the 200-day EMA. Here is S&P 500 on a weekly time frame. A few weeks ago I pointed out this triangle consolidation with a rare 2 inside weeks in a row. Inside week is basically when the entire this week's range is within the previous week's range, and the same goes for the week before that. So you can say it's like a triangle consolidation with a big breakout. Now you can see that we moved to a yearly resistance pivot point up here. We pretty much touched it, and then we just pulled back. So this could be like another sign that we're reaching an end of a move, sort of. Because you can see we basically moved from pivot to pivot. So we may need to take a little bit of a rest. But long-term picture, I think, is very much bullish. Very similar picture on the Dow Jones Industrial Average. Also a gap here last week to all-time highs. And now we're basically correcting within this very much bullish uptrend. Longer term, I don't see any issues. These are all-time highs and advanced decline lines as well. Let me just briefly look on the weekly time frame and see if we came kind of close to the resistance point, but maybe we'll actually continue higher. Let me see. What about Dow Jones ETF? Same thing. So we're kind of approaching a resistance point, and possibly we may need to correct from here. Moving on to QQQ, this is very much a leader right now, and also very bullish, also with no divergences. You can see advanced decline lines are moving higher together with the underlying index, and actually on Friday we came very close to making fresh all-time highs. So again, very strong looking chart to me. Longer term, look at this RSI reading for QQQ. It became overbought, became more overbought, corrected a little bit, and now again overbought. So very strong readings as well. Longer term, again, I don't see any issues with the bullish percent index and percentage of stocks above the 200. You can see very good high readings and no divergences that I'm aware of. We start to get into a little bit of a weakness here in the Russell 2000 Small Caps ETF. This is a, even though we did hit all-time highs together with the indices last week, I pointed out divergences here on the advanced decline line and advanced decline volume line, which are actually getting worse. So there is a little bit of a divergence, and we can see like a little bit of a break to the downside in the advanced decline volume here. So maybe we'll see further correction, because you can see that this level right here in December is above this level that we just reached, that we just hit this Friday. So maybe we'll see a correction further to, let's say, 130. But longer term, I think this is a buying. If we correct any further, I think it will be a buying opportunity, basically. Here we see a little bit of a divergence in the percentage of stocks about 200-day exponential moving average. How much of a concern it is for the general market, for the bigger S&P 500 is difficult to say, because I think the small caps index is like 15% of the bigger market. So it is not a very big part of the market, but it could be like a canary in a coal mine. So they correct before the big dogs start to correct. So we'll see where this goes, basically. So what were the leaders this week? Technology sector, XLK, fresh all-time highs. A little bit of a tiny divergence, but I'm not sure if I can call it that. It's very mild. We'll see where this goes, but this is very mild still. So probably not much to worry about just yet. Here is the financials, also all-time highs, but just last week. Same thing, confirmation by the advanced decline line, so I don't see much to worry about just yet here. Here's one that's kind of interesting. This is consumer discretionary, XLY. We did hit all-time highs here in together with the general market, but the advanced decline line, for especially the volume advanced decline line, didn't hit the all-time high since December. We came pretty close, but didn't so far. So I wonder if this is a something to worry about, or maybe it will resolve to the upside. In fact, here is XLY in the weekly time frame, and we just had another inside week. So you can see that this past week's range is within the previous week's range. So this could be thought as a triangle consolidation. Now, in a bullish security, a triangle consolidation is a bullish continuation pattern. In other words, once we see a breakout, we can expect fresh all-time highs. For example, you can see here triangle consolidation. You can see an inside wick right there, and then breakout, fresh all-time highs. Another inside wick, fresh breakout, fresh all-time highs. And vice versa, it could also work the opposite direction. You can see here that we had an inside wick, but then we had a breakdown from there. So you could think of inside wicks as kind of like a powerful prelude to a strong move higher or lower. It's just not 100% which way it will move, but it is like a consolidation basically. So we'll see where this goes where this goes. I mean, we've been having all these breakouts to fresh all-time highs, so maybe this is the time that bears will take control of the ball finally. As far as industrial sector also all-time highs, confirmation from advanced decline line. So very strong move, very broad participation in the advance. Here's healthcare, a very unlikely one. Just back here in October, November, I heard that opinions that healthcare is in a bear downtrend, and I maintain that this is a temporary underperformance. So we had this big move here during November election, sideways chop, but then finally we're at all-time highs. And I actually pointed out that advanced decline lines hit all-time highs before the move in the index itself. So we were hitting all-time highs in advanced decline lines back in January and February. So this was actually a buying opportunity. Now it looks like XLV is outperforming other funds. Stocks have very high correlation to one another, and stock funds have high correlation to one another. So I would not say that one sector is strongly bearish while other is strongly bullish. They have very high correlations. All right, and then here's a little bit of more defensive sector, XLP, also all-time highs, and actually the same thing as XLV. We were hitting all-time highs in advanced decline lines back in January and February, and I kept pointing this out, if you listen to my previous videos, that this was a buying opportunity, basically. Here's the one that really got slammed, and this is real estate. Very unusual move. You could see that we had basically 10 red days in a row, and this is a record for real estate, this particular fund. This has never happened before. So unusual events do happen in stock markets, and you have to deal with them, basically. But this happened because of the drop in bonds. In other words, the interest rates went up, and of course real estate is more interest rate dependent than other stock funds. But nevertheless, real estate, IYR, these are REITs, real estate investment trusts, and these are stocks. So I think if the general market continues higher, real estate will do just fine. Here's utilities. This one also is more interest rate dependent. You can see this gap here, and this was when the bonds decided to drop. But they're not dropping that much, and actually all-time highs, these are like within a couple of cents of all-time highs. So how much of a concern this is, difficult to say. I think that bonds are, we're going to get to bonds in a few. I think bonds could be actually getting ready to bounce higher. And finally, here's one I don't normally look at. This is IYZ Telecom. Also, these are utilities, so you can see that they were dropping. But now it looks like we're actually bottoming, and this could be like a classic case of bullish security, uptrend in security, now being sufficiently oversold. So we'll see where this goes, but we have to also be cognizant of what is it composed of, and you can see that AT&T and Verizon is 20% of this fund, so it's pretty top-heavy fund. But in any case, this could be an interesting opportunity in the days and weeks to come, basically. So to summarize, I think stocks are bullish in the long term, and right now we're more or less working off the overbought conditions. But fresh highs, I think, are more likely than a bear market from here, obviously. Right, and here are the junk bonds, which I kind of consider an extension of the stock market, but nevertheless, they do have a little bit of a, well, quite a bit of bond characteristics, of course, and you can see that all bond funds more or less dropped this week, and for junk bonds, this was all-time highs here, and then we, dropped quite significantly for the bond fund. These are all-time highs for JNK, so I think eventually the bottom will be found, and I think we'll be continuing higher from here. Here's a weekly time frame for the same fund. You can see we had some similar in October and November, but then eventually the bottom was found and we made fresh all-time highs. So I think long-term junk bonds are in a bull market, and this is actually quite good news for the stock market, because you can see correlations are very high with junk bonds and stock market. Now if we move higher the investment grade scale, this is investment grade corporate bond fund, LQD, big drop here. We tried to break out here actually just in February, and we started feeling this gap here, but looks like we got significant resistance and strong resistance here at the 200-day moving average, together with the unfilled gap, and then we just unraveled from there with a big gap and continuation. Importantly, I thought here in January and February, I thought we were bottoming. Look at, we had 1, 2, 3, 4, 5, maybe even 6 hammer-like candlesticks. In fact, I thought that this was the 7th here in March, but then we broke below it. So it's looking like we may retest this lows from December, and if that happens, these are going to be 52-week lows. By the way, this is a total return. In other words, the prices are adjusted for the dividend yield. If I took out the dividend, these are already 52-week lows. I believe so. Let me see. Actually, no, not yet, even without it. So we'll see where this goes, basically. And here we're getting to some really interesting events. This is TLT, 20+ year Treasury Bond Fund. This, you can see we had big drop here. This fund kind of attempted to break out, but never actually even got anywhere close to filling this gap. And then we gapped down here beginning of March and continued lower. So these are 52-week lows. And additionally, if I took out the dividends, let me just show you what I mean. I'm going to, these are already 52-week lows, but if with the dividends, you can see we kind of bounced and we haven't made a fresh low just yet. But if I take out the dividends out of the equation, then these are actually already fresh 52-week lows. So this is a 11668 below this low 11680. So this is not looking good, but also it's possible that we're a little bit oversold and we may actually bounce. This also will depend on what the stock market will decide to do. If the stock market decides to maybe take a pause and possibly pull back, then bonds would be the logical choice for the investors. Right now, it's sort of difficult to make a bullish case on bonds. In fact, here's TYX, which is a 30-year US Treasury bond yield, and this is a weekly chart. This is a intraday high here, so this is a 52-week high here that was set this week. This is quite an amazing achievement because Treasury bond yields have been steadily dropping for the past 35 years. So let's look at that. This is a 30-year US Treasury bond yield. Yield and bond prices go opposite direction. So, for example, here TLT is dropping, but yield is rising. So here is a monthly chart of TYX, which is a 30-year Treasury bond yield. This is going back 40 years, so about 1981, 82 we peaked out, and this is kind of like a great bull market in bonds began. In fact, let me just show you what I mean, because this is kind of confusing for new investors. So U.S. bonds have been rising, while what I'm talking about here is the yield, which has been dropping as the bond prices have been rising. So let's zoom in on this part right here, and you can kind of see that which has been dropping, and there was no high uh, ever that was made. I mean, right here was a higher high, right here was higher, but we never actually made any kind of follow through. So we tried like there as well, but we just couldn't move higher. So there was no, bona fide breakout. Here we have a possibility of that happening in the not so distant future. It of course will depend if this will ever happen or not, but let's just take a look at the past 4 years, and this is a monthly chart. So here's what I did is I marked the high from June of last year, basically 2015 rather, and I think that if we close above this level on monthly basis, I think we're going, I'm going to say that we have basically ended this great um, bull market on bonds, and maybe now is going to be the opposite. Now maybe bonds will be dropping and yield will be rising. This hasn't happened yet, and this is a bottoming process that could take a long time. So once again, I wouldn't completely write off bonds just yet, basically. All right, then let's move on to the currency and forex universe. Here's US dollar in the weekly time frame. This is a bullish chart. These are multi-year highs, and now we're pulling back to the basically breakout level and bottoming out around the breakout level, and I mean breakout above these highs here from 2015. Past 4 weeks, this last week dropped a little bit, so it's possible maybe that the dollar will take a pause and maybe even pull back slightly more. But I think in a generally long term, it is still very much bullish. And especially now, if the interest rates go up, I think it will be actually helpful to the US dollar. Euro versus US dollar. If the dollar, if euro decides to continue higher, of course this will weigh on the dollar, and in fact I think we may retest the highs from the previous week's bounce here. Maybe we'll see a little bit of follow through to the upside to like 108, 108.3 area here. But I don't think we'll go much higher, and I think fresh lows are more likely now than a breakout to the upside. In fact, here's another European country, British pound, had a triangle consolidation with a inside wick and then with a bearish resolution. Actually, this spike is exaggerated on this chart. I guess various data vendors have somewhat different data sets, but on TradingView, this chart does not look as bad as on this chart. So on TradingView, this chart looks like it's like around here. So maybe we'll continue lower and actually break the fresh multi-year lows. This is very much a bearish chart. And here is US dollar versus Japanese yen, which is the opposite, traded oppositely. So in other words, the US dollar, in this case, it looks like to be gaining here. We had a big surge, pullback, and looks like we're continuing higher now with 2 bullish weeks in a row. So to summarize, I think the dollar is bullish in the long term, and I think this will weigh on precious metals, which we'll cover next. Okay, here's gold in a daily time frame. So gold is, I guess you could think about as inverse dollar, because gold and dollar usually move opposite to one another. Here's correlation coefficient. You can see that it is usually negative. We had a little bit of a positive correlation for the past month or so, and we can see that the dollar was moving higher together with gold. Excuse me. But now it looks like we're unraveling back into normal negative correlation. In other words, dollar is moving higher, gold is dropping and dropping strongly. The 200-day moving average acted as resistance here on this chart of gold. So this one is a difficult case. Maybe we'll see another attempt to go higher because we're somewhat oversold after this big plunge, but I am leaning more and more bearish lately. So here's GLD. You can see the same thing. This one has a little bit of a more bullish look here. You can see this candle is a hammer-like with a follow-through candlestick. So maybe we're attempting to bottom here. Here's gold on the weekly time frame, and last week I pointed out this bearish engulfing. So it's this candle from 3 weeks ago is completely engulfed by this candle from the week before, from last week. So you can think about this bearish engulfing outside reversal, and now it definitely is confirmed because we had follow through to the downside. So this looks like we may see more downside before the bottom is found. Now if we get to this levels at 1124 here from December lows, and we decide to go lower, that would be 52-week lows. So that also doesn't bode well for gold. Now GDX, gold miners ETF, it is a lot more volatile. If you listen to my previous videos, when we got to these levels here in February around $25, I was saying that now maybe the bears are gonna come out of hibernation because this is an obvious resistance level, and this obvious resistance level played out really well. Bears were extremely successful here, and maybe now finally the bulls are coming out of hibernation. And because like I guess I can make a case that we're attempting to bottom here. As far as the market breadth is concerned, it clearly deteriorated further. There's no overt bearish divergence just yet, but we are getting new lows, which we haven't had in like a year. So new lows are appearing, and this does not bode well for the GDX and the gold miners, obviously. So maybe we'll bottom here, and maybe we'll attempt another bounce. But now I'm less and less optimistic, I guess is the word. Here's the reason why I'm less and less optimistic. Here's GDX, and this is Gold Breadth Index, my proprietary digital signal. So right now we're still in a bull market, according to this system, but we're at 2. In other words, if we get to 1, we're in a bear market. And the thing is that here's one of the inputs for that indicator. It's GBI raw data. You can see we got worse. This is a longer term input, so we can see we're at 75 here. We actually dropped to 50, so we got worse in this department. We are definitely oversold. In fact, here's another of my experimental indicators. This is ITBM, intermediate term breadth momentum oscillator for GDX, and this was one of the more extreme oversold levels. So we're definitely oversold. Another indicator I created is a percentage of stocks within the index on in a buy signal. And looks like we are bottoming in that department as well. So looks like maybe we'll see bottom here, and maybe we'll attempt a move higher. But I am again more and more concerned about this security, especially if the dollar continues to gain. Here's GDX on a weekly time frame. I guess we're playing off this level right here, and so far we did not break below it. But if we do break below it, this here around $18 are going to be fresh, these are going to be 52-week lows. Back here in December, these were not yet 52-week lows, but if we do come down there, this will be 52-week lows. And by then, I'm going to say most likely this is going to be a bear market. Alright, and here's West Texas Intermediate light crude oil in the weekly time frame, and this is a chart that I showed last week. So this is as of March 3rd of this year, so last week's chart. And last week I pointed out that finally oil made a break one way or the other, where it was able to close below the previous low, even by a few cents, but it did manage to close below the previous low on a weekly basis. And this represented a kind of like a major catalyst, I guess. You can see the weekly, this is what I pointed out last week. This was the first close below last week's low in 12 weeks. As you may know, this week we forward here, this is this week's drop, 9+% drop, and this just shows that technical analysis does work quite well. So I've been pretty consistent. If you listen to my videos, I've been pretty consistently bearish on oil. I just did not see it going much further, much higher. So looks like the bearish case is playing out, and here's the weekly time frame. We had a very long consolidation. We had 12-week consolidation. Now finally with a breakdown. We had very similar here back in 2015. We had 10 weeks consolidation also with a breakdown back then. We had a similar picture back here in 2015. We had a longish consolidation, then finally big break, and then we just unraveled from there for quite some time. Had a bounce and then continued lower. Now we had something similar now. We had a big long-term consolidation with a big break. Now, are we going to get a similar move as before? I have no idea, and I don't think anybody knows either. Here's an interesting article I came across, and this is from a McClellan Financial Publications by Tom McClellan, a very respected analyst. He was saying that there's a huge imbalance in crude oil positions, and there was lots of commercial net shorts, kind of like a smart money, I guess is the word. And very interesting article. I think you should read it. But the point that he's trying to make is that crude oil has likely to fall for a while, and we'll probably know that the oil is done falling only when we see commercial traders covering their shorts in a big way. So I kind of have to agree with this assessment, and I think that, I guess maybe we'll get to like 39, but I wonder if we're going to hold that level. Again, anything is possible in the stock market, and we could just stop here and turn around with a vengeance and continue higher. That is also possible. However, I don't think it's likely going to happen. I think that, my money is on the downside, I think. So at the very least, I see oil getting to like low 40s, I guess, and possibly lower. Here's an interesting piece of the puzzle. Energy ETF XLE, it peaked out here in December and then kept sliding ever since. And I also kept pointing out these divergences in the advanced decline lines, and now looks like they're playing out. So I thought that this was a legitimate breakout here above, around November here. It was unfortunately not confirmed by the advanced decline line. It was confirmed by the advanced decline volume line, but not by the advanced decline line. But here I think we're actually unraveling and breaking below the breakout now. So I wonder if this breakout was valid. Here's a longer term XLE picture, very interesting. You can see that in both instances of in 2015 and now, oil related energy ETF started dropping before oil, took a dive. You can see oil was trading sideways, but energy was already dropping. The same goes here. Energy was already dropping for some time, but oil was trading sideways, and now finally oil is dropping together with the energy ETF. So I now wonder if energy ETF is going to continue lower, or maybe it will bounce with the general market. Who knows? But if I just look at this picture, this does not look really well for energy or for oil for that matter. It looks great if you're short. Here's another one. It's an oil-dependent country, Russia, RSX. You can see a similar picture. Russia started dropping here back in 2015 before oil took a plunge, and then Russia just continued lower. Big bounce together with the general market and oil, and now again oil was trading more or less sideways, while Russia already started dropping in early February. So very interesting correlations here. If oil continues lower, I think Russia will follow as well. Here's natural gas on the daily time frame. Very volatile security, so be extra careful with it. So 52-week highs correction, very deep correction. I actually thought we were gonna come down even lower to like this breakout level, but I guess we bottomed out and rallied from here. So on the weekly time frame, you can see that we had two strong bullish weeks, and we had a big gap here as well. So this looks like a good looking bullish chart basically, and I think we may see a little bit of a correction and maybe follow through higher. So that's it for this week's recap. If you found this video useful and interesting, please do like it. If you have any comments or questions, please don't hesitate to send them in or comment below in the comments section. And of course, share this video with others who might benefit from it. Please stay tuned on how to find us on the internet. Thanks for watching and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success as trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. send it here, and I'll be hopefully I'll be able to answer it for you. All right, thanks for watching, and please consider signing up for the trailer services. Bye-bye.